On a normal Monday, your paycheck lands, your balance spikes, and for 10 seconds you feel safe. Then the auto drafts hit and the number suddenly collapses. That whiplash is the clue. Most people think passive income starts with picking stocks. It does not. It starts with removing friction so ownership can compound while you are tired, distracted, and busy living your real life. Today you will see the path from zero to a machine that can send $5,000 per month. The twist is that we build it backward, starting with cash flow rules. If you have ever wondered why saving feels heavy, it is because saving ends when you stop. Ownership does not. Ownership keeps earning when your willpower runs out. We are going to build a complete hour-long blueprint, but we will move in 5 phases. Each phase locks in a decision so you stop renegotiating with yourself every month. Along the way, you will learn one metric most investors ignore, yet it predicts when your income becomes self-sustaining. When you track it, the timeline stops feeling like hope. Before we touch a single ticker, you will build the foundation that makes the rest automatic. Because if the system needs daily motivation, it will break the first week life gets loud. My name is Dave, and if you want simple money math and autopilot systems, like the video, subscribe and ring the bell. Comment: which bill would dividends replace first, and why exactly? Phase 1 is the frictionless start. You audit every place cash is sitting idle, checking buffers, leftover savings, and the money you keep just in case even though it never gets deployed. Then you move that stagnant cash into a high-yield settlement account connected to your brokerage, so every dollar earns something while it waits. Cash should earn interest or buy ownership. Next, you choose a brokerage built for fractional shares and recurring transfers. The feature is not flashy, but it is powerful because it eliminates manual decision fatigue and missed months. Your recurring transfer should align with your income cycle. If you get paid bi-weekly, invest bi-weekly. If you get paid monthly, invest monthly. The plan must fit your calendar. Now you set the 2026 account structure. Think in buckets: a tax-advantaged retirement bucket for efficiency and a taxable bucket for flexibility and early access. In the retirement bucket, you prioritize assets that create higher tax drag in taxable accounts. In the taxable bucket, you prefer qualified dividends and long-term holds to reduce unnecessary leakage. This is not about perfection. It works because the biggest gains come from staying invested, not from cleverness. Your first job is to make the system easy to repeat. Phase 2 is the selection engine for sustainable yield. You are not shopping for excitement, you are assembling parts for an income machine. The engine uses 3 screens, always. Screen 1 is payout discipline. You avoid companies paying out almost everything they earn because one bad year forces a cut. A healthier payout leaves room for growth and shocks. Screen 2 is dividend growth. You look for 5-year growth that is consistent, not a one-time spike. Dividend growth is your inflation shield, built into the paycheck. Screen 3 is durability. You prefer strong cash flows, resilient balance sheets, and long histories of paying through ugly cycles. Durability matters because your bills do not pause. Now you build a watch list that blends dividend kings with dividend growth exchange-traded funds. Kings bring stability, and funds bring diversification. Together, they reduce single company risk. You also spread across sectors: staples, healthcare, industrials, utilities, financials, and quality real estate. Diversification is not for bragging, it is for surviving storms. It keeps headlines from wrecking you. Before you buy, calculate the weighted average yield of the watch list. Multiply each holding's yield by its planned weight, then add the results. This gives a realistic income starting point. Then compare that yield to inflation. If inflation runs near 3% and your yield is 3%, you need dividend growth to pull ahead. Growth is the second engine. Phase 3 is architecture, the automated cash flow machine. First, turn on dividend reinvestment for most holdings during accumulation. Reinvestment works because it buys shares without permission. Second, set position limits. No single stock above 5% and no single sector above 25%. This protects the income stream if one industry takes a hit. Third, design a monthly deposit split. I call it the three-box buying routine. Box 1 is core growers. Box 2 is diversified dividend funds. Box 3 is opportunistic quality yield. For example, you might send half to Box 1, 1/3 to Box 2, and the rest to Box 3. The exact weights can change, but the structure keeps you consistent. Now automate the buys so deposits turn into ownership quickly. If your deposit lands and sits in cash, you are paying an invisible fee called procrastination. Speed matters at the start. Set a review schedule, not a doom scroll habit. One brief review per month and one deeper review per quarter is enough. Random checking creates anxiety, and anxiety creates bad trades. During reviews, track 5 numbers: total invested, monthly dividends, weighted yield, dividend growth trend, and your distance to the crossover point. These numbers keep you focused. Phase 4 is optimization for a tax-efficient crossover. Start by separating assets that produce qualified dividends from those that produce non-qualified income. After-tax cash pays bills, not labels. Place higher tax drag assets inside tax-advantaged accounts when possible, and keep qualified dividend-focused holdings in taxable if you want flexibility. This simple placement can raise net income. Now measure yield on cost. If you bought at a lower price and dividends grew, your yield on cost climbs over time. Yield on cost proves why early ownership feels slow, then obvious. Set rebalancing triggers that are automatic, not emotional. If a holding grows above a predefined cap, trim back and redeploy into underweight quality. Rules prevent panic and greed. When a holding becomes overvalued relative to your screening standards, you do not chase it higher. You redirect new money into better value opportunities while letting strong businesses keep compounding. Also, protect the machine from 3 killers: lifestyle creep, panic selling, and yield chasing. Those 3 destroy more portfolios than recessions because they attack behavior. If you get a raise, increase contributions before upgrading your lifestyle. This works because your savings rate is the steering wheel of your timeline. More margin compresses years into months. Phase 5 is scaling to the self-sustaining milestone. The milestone is the crossover point, when monthly dividends exceed your monthly deposits. That is the ownership flip, and it changes everything. Here is the math. $5,000 per month is $60,000 per year. If your portfolio yields 3%, you need about $2 million invested. That is the mountain. But the mountain is climbed with 3 forces: contributions, dividend growth, and reinvestment. When those align, the curve bends upward and progress becomes visible. You stop guessing, because checks prove it. Start with smaller milestones so your brain feels momentum. First aim for $1 per day in dividends, then $5 per day, then 10. Small wins keep the system alive. Now, increase contribution margin as income grows. I call this the ladder of leverage. Every time your invested total hits a new threshold, you raise your recurring deposit slightly. For example, at $10,000 invested, add 1 extra weekly payment. At $25,000, add another. The exact steps do not matter. The habit of scaling is the secret. If you carry high interest debt, use a split approach. Pay down the leak aggressively while still investing a small amount. I call it the leak plugging protocol because identity matters. Once the leak is plugged, you redirect that payment into the machine. Many people discover they can invest far more than they expected because the money was already leaving their life. Now forecast the long-term engine. Use conservative assumptions: 3% yield, 5% dividend growth, and small annual contribution increases. Conservative math builds confident action. As the machine grows, decide when to switch from reinvesting to taking cash. The switch point rule is simple. When income reduces stress more than growth accelerates wealth, take cash. Finally, track the after-tax crossover, not just the headline dividend. Your goal is $5,000 you keep. When you measure what you keep, the plan becomes real-life ready. Let's make phase 1 concrete. Open a note and write each account balance, tiny ones too. What you measure stops hiding from you. The goal is not judgment, it is clarity for deployment. If you keep a buffer in checking, define it. Pick a number that covers essentials, then stop letting the buffer grow quietly. Anything above that number immediately moves to your settlement account. Automate the move on payday so you never see the extra cash as spending money. This works because your eyes negotiate, but your automation does not. Remove the argument before it starts. Now build an emergency fund separate from investing. 3 to 6 months of essentials is common. The purpose is psychological. It prevents you from selling ownership during a crisis. When the emergency fund is in place, your investing deposits become calmer. Calm investors hold through dips, and holding is where the math actually works, even when life hits. In Phase 2, your screening engine should be written like a checklist. Revenue resilience, payout safety, dividend growth history, and reasonable valuation. If a company fails one screen, it pauses. A simple payout safety check is coverage. Can free cash flow cover dividends with room left? If dividends need perfect conditions to survive, they will not survive, even when life hits. For dividend growth, look for a steady pattern. 5% annual growth beats 20% one year and 0 the next. Smooth growth is how your income becomes predictable. On your schedule. For valuation, avoid paying any price for a great business. If the valuation is stretched, you can still own it through an exchange-traded fund while waiting for better entry points. Now about dividend kings. They are not magic. They are simply businesses with long proof. Proof matters because you cannot pay your rent with a promise. For years, about funds, pick ones that emphasize quality, dividend growth, and low turnover. Low turnover reduces tax drag and keeps the strategy consistent without constant tinkering. Even when life hits, when you blend kings and funds, you also reduce the risk of one management team making a bad decision. Diversification is a humility tax, and it is worth paying today. Now Phase 3 again, automation. Set dividends to reinvest, but also set your deposits to purchase within 24 hours. The goal is to turn time into shares quickly. Today, if your platform allows scheduled buys, set them for the day after deposits land. This works because delay invites doubt, and doubt invites skipping. Without extra effort, your sector model should include defensive and cyclical exposure. Defensive sectors keep income steady. Cyclical sectors add growth. The blend prevents one economic phase from dominating your outcome. If one sector runs hot and becomes too large, your triggers trim it. If one sector is depressed yet fundamentals remain, your deposits buy more. Your rules make you buy low. Now a quick example of weighted yield. Suppose half your money earns 3% and half earns 4%. Your weighted yield is 3.5%. That guides projections. If you need $60,000 per year and your weighted yield is 3.5%, you need $1,700,000 invested. Math turns fog into a map. But you do not need $1,700,000 today. You need the first 1,000, then the first 10,000, then the first 50,000. Momentum is built in layers. Here is the first layer goal. Reach $100 per month in dividends. That is groceries for people. It proves the machine works and it makes the next deposit easier. Second layer, reach $500 per month. That can cover utilities, insurance, or a car payment. When dividends cover a real bill, the plan stops feeling theoretical. For years. Third layer, reach $1,000 per month. Now the machine begins to feel like a second income stream. This is where many people stop chasing quick wins because they see compounding. Now let's talk about dividend reinvestment versus cash. During accumulation, reinvestment compounds. During transition, you can split, reinvest half and take half as cash to reduce stress. Today, the split approach keeps growth alive while giving you relief. Contrast word, not all or nothing but both, because both protects consistency long term. It lowers pressure, so you stay invested. Now taxes again. Qualified dividends often receive favorable treatment compared to non-qualified income. Holding periods matter, turnover matters, placement matters. Your system respects all three. Today, a simple rule is to avoid selling in taxable accounts. The more you trade, the more you invite taxes. Taxes are not evil, but they are friction, and friction slows compounding. Now yield on cost again. It grows when you own a company that keeps raising payouts. You might start at 2% and later your yield on cost becomes 5%. That does not mean you ignore current yield. It means you respect the journey. You are building future income with today's patience, and patience is a strategy, not a mood. Today. Now rebalancing triggers. If a holding exceeds your cap, you trim to the target. If it falls but fundamentals remain, you do not panic. You keep buying through deposits and reinvestment. This is why the engine is mechanical. When you decide rules in calm moments, your future self can follow them in chaotic moments. That is the hidden advantage of systems. Today, now the ladder of leverage in practice. Each time your income rises, you raise contributions before you upgrade lifestyle. Even a small increase compounds because it repeats every month. If you increase contributions by only $50 per month, that is $600 per year. Over years, it becomes tens of thousands deployed. Small levers move heavy timelines. Today, now the leak plugging protocol. If debt interest is high, your win is control. Pay it down, but keep a minimal recurring investment, even if tiny, so the habit never dies. When debt is gone, you redirect that old payment to investing. Many people find they can suddenly invest hundreds per month. The money was already committed, you just changed the direction. Today. Now the crossover point becomes visible. When dividends equal deposits, the engine funds its own growth. After that, every year feels faster, because income is buying more income. This is why I call it the ownership flip. Before the flip, you are building the machine. After the flip, the machine is building you options. Today. Now we address the target again, $5,000 per month. You can reach it by combining quality yield with dividend growth, but you must protect the engine from cuts and concentration. So you keep screening for payout safety, you keep diversification limits, and you keep rebalancing triggers. Your job is not to predict, your job is to endure and accumulate. Today. When markets drop, you do not stop deposits. You do not wait for certainty. Uncertainty is where future returns are purchased because prices discount fear. Your automation buys anyway. When markets soar, you do not get arrogant. You stick to your weights and you redirect new money to fair value. The goal is steady ownership, not emotional victory. Today. Now the metric people ignore, after-tax income progress. Track what lands in your pocket, not just what is declared. Lifestyle is funded by what you keep, not what you earn. If your after-tax dividends cover a bill you celebrate, then you raise the next target. The process becomes a game of replacing expenses with ownership, line item at a time. Now open the loop. $5,000 per month is not the first goal, it is the symptom of a system that never stopped running. Build the system, and the symptom arrives. So tonight, write your first move. Move idle cash, automate deposits, start the 3-box buying routine and track the 5 numbers monthly. When you start, the future begins compounding. Today. Answer this in one thoughtful sentence. What expense will you replace first with dividends, and what exact change will you make this week to increase your contribution margin, personally starting today? If you want a simple next step, set a recurring deposit that feels easy. Then promise yourself you will only change it upward. Easy deposits protect streaks, and streaks create wealth. Because the truth is simple. You do not need perfect timing. You need a plan that keeps buying ownership while you live your life. Build that plan and cash flow follows.